Hi, everybody. Welcome to another episode of the 7 and 7 Show with Zack Ellison. Today, I have with me Samantha Lewis, a partner at Mercury Fund. And Sam, thanks for joining.
We've covered some of it, so I'm just going to
Yeah,
almost summarize a few things that
yeah,
we've.
perfect.
So, venture is and always will be a game of outliers, right? It just is. That's like the power law kind of 101 of venture. But that does not mean that you can't provide consistent returns, fund over fund over fund, by deploying better portfolio strategy, right? And we've already covered this. How do we do that? We drive DPI. Okay, well, how do you drive DPI? There's many different ways, or a few different ways to do that. We think we've nailed one. And so, or a few. So I think that that's super important because you still need the outliers to have outsized returns, but not every single one of your companies needs to be an outsized return. You can also do base hits, right? It's okay to have a $500 million exit. It's okay to have $100 million exit if you have enough ownership. It's really not about the number, it's about the returns, the cash on cash returns. And I think a lot of times in venture, people do not think about that and they don't optimize for that. And again, like I said, you don't have to just take my word for it. Our model has proven it with being in the top decile of our vintage year for Fund 4, but also one of our big LPs is Baylor Endowment. And they were written up in the Wall Street Journal, I think like 2 weeks ago, that their endowment is now basically leaving the Ivies in the dust. They're killing it. And they're very contrarian when they're thinking about how you deploy into venture. And they love our model, right? They love it. Just like the same things we're talking about, Zach, here on really thinking about fundamentals and thinking about how to drive cash on cash returns and all this other stuff in venture is a very attractive thing because it lasts through cycles. And institutional LPs want to know that you're going to be able to last through cycles. And so Mercury has been able to figure out how to get venture upside with private equity downside. And that is a super bold statement, I know, but like now we have a few different cycles where we've been able to prove that. And so we continue to hone that model and hone that model. And LPs who are attracted to that opt in to coming to us. And some LPs don't want that. Some LPs want just the power law, and it's okay to have 50-60% loss ratio. And then, then they might not be the best fit for Mercury. And so I think that's a common mistake across venture, and it has ramifications on so much. And this is why I wish more venture funds would think the way that we think, not just Mercury, but kind of funds around like RGOs. Because when venture capital dries up, innovation dries up. And when innovation funding dries up, this has ramifications about everything, security of the country, right? About economic viability of certain things within our nation state. Like I could get very philosophical and we don't have to go down that rabbit hole, but people need to think about how to build venture, I think, in a more successful, sustainable way so that innovation funding doesn't completely evaporate whenever we're like in a bust cycle. So that's how we think about it. We want more, the billions and trillions of dollar fund managers out there to think about it that way too. But to
You know, I,
each their own.
I love the way you think about it. And I think that's why, I really wanted to get you on the podcast because the way that you and the others at Mercury are thinking about it really jives with the way that I think about it as well. It need not be a dart throwing game. There are consistent, repeatable processes that you can utilize even in early stage venture equity to generate consistent outperformance. And I think there's this like false narrative out there that was probably generated by the VCs, which is like, hey, listen, we can't really be process driven because this is too early. So we have to kind of just make 100 bets and hope that 5 of them are big winners and another 10 are 2 to 10 Xers, right? And I just think that's a false narrative, and that's from like 40 or 50 years ago from people that didn't really understand how to manage portfolios in a sophisticated way. And to add to
Well,
that,
it's
I
a
would say,
super early industry. I don't mean to interrupt, but like,
yeah,
right? I think we can't overlook that like venture has been around for a fraction of the time of other types of investment models. Like venture kind of existed with power law and things like that, like in the whaling industry and things like that, right? But venture is a very young. So when people think we have it all figured out, we do not, right? As an industry, we don't, because the type of environment we just went through is really, some would argue, second time we've only gone through that. And I'd argue the first time we've really gone through that type of cycle. And so like we as an industry need to remember, like we're adolescents compared to a lot of other finance professions.
Well, and part of that's because venture capitalists, although many are brilliant, they're not trained investors. Like there's a very different mindset and skill set that you see on Wall Street from people who have gone to, University of Chicago, Booth School of Business, versus somebody who's like, listen, I didn't even go to college. I started a couple companies. I'm a great operator, and now I'm a VC. Like both are smart, both are great at what they do in many respects, but they're inherently different beasts, right? And I think that VC has gotten sloppy or has always been sloppy, not gotten sloppy, but it's been very, very sloppy 2021 and 22, right? And I think there needs to be a reset and a rethink about the whole industry. I don't think that VCs are very good investors generally. Like getting lucky is not investing. Like it's
Yes.
not. It's like,
No.
no, I'm sorry, it's not. If you can't do it with a consistent process, then it's luck.
Yes.
And there's 50 finance books you can read that prove that. I mean, I've got an MBA from Booth and a master's in risk from NYU, and I'm working on my doctorate in business at University of Florida, and this is what they teach you. I mean, the only reason I bring it up is like I'm not just like pulling this out of thin air. I mean, this is what the best schools in the world will teach you. This is what the CFA teaches you when you get the CFA charter, or the CAIA, the CAIA, right? They teach you how to invest, but they teach you how to think through things in a logical way and become process driven, look for repeatable ways to generate outperformance.
That's
So
key.
anyhow, this is just one of my kind of, in a way, like, not pet peeves, but I just look at the industry. It's just disappointing, right? It's just like so many people that
Mhm.
pretend they're investors, and like you don't deserve to have that on your business card.
And the sad thing is though, those people, if they had luck, LP Capital still chases them.
Yeah.
So LP Capital will still chase those. And listen, being an LP is very difficult. I know that. I have very many friends who are LPs, and they talk about how you are trying to decipher whether it's luck or whether it was skill. And that is very, very hard to do as an LP. So I don't necessarily envy that. But a lot of capital flows to those who are likely just got lucky. And then unfortunately, a lot of capital, especially in this market environment we're in, is not going to flow to emerging managers who actually might be great investors because they're not going to be able to drive liquidity in a short period of time to be able to raise their next fund. And so it's almost like this cycle that just keeps repeating itself because then luck cause like the lucky ones to be able to get significant more capital. And
Yep.
then they're going to sit on that capital and continue to deploy. And I don't want to take us off too much, but there's a super interesting tidbit here that I've been
Yep.
thinking about. So I'm reading Annie Duke's book, Thinking in Bets. Have you read this?
No, I haven't, but I've
Oh, you have to.
heard of it.
Okay, so Annie Duke was a world champion poker player. Okay, she also has PhD in cognitive behavioral science or something similar to that, right? And so she now coaches and speaks to a lot of different traders, Wall Street type traders and big CEOs. And she works kind of in venture industry too. And so what she says is that people need to separate the quality of the decision you make from the outcome. And inherently, we are terrible at doing that as humans. So we think if the outcome is good, that means our decision making, like our pattern matching says, okay, that means our decision making was good. So then we keep deciding things based on what could have been a very flawed decision in the beginning. And we're seeing that play out now through the market, through the VC market. So people said, this worked, that means it must have been right. And then they make that same decision again. So that must have been right. And then eventually the house of cards falls. And so it's super important to think about and dig into the quality of your decision making. And so whether that is, I made a bad decision and had a good outcome, that is just as important as understanding as I made a good decision and had a bad outcome. Because that doesn't mean I shouldn't make that decision again if I went back. And so I've read the book before, but we're reading it as a book club at Mercury right now. And it's just fascinating because it applies perfectly to our industry. So anyways, that's a
That's a
side
great
note.
example. I appreciate that. That's a great example. And in the spirit of examples and anecdotes, I'll give you one that I think is amusing too. So there was an angel investor who had worked at one of the big tech companies, and he had made hundreds of millions of dollars as an angel investor during his career there because he had great information flow on everything, because this is one of the behemoths, right? So he saw everything. And so this is a couple of years ago, but he was basically trying to raise external capital for the first time for kind of an angel stage, early stage fund. And in his pitch deck, he had all the investments that he had made that had done well, of course, not all the losers, not the like 95% of the investments that were zeros,
Yeah.
but the 5% that had done well. And the best performing investment was Pinterest, which many people know. And he had put in 25K in a very early round. I can't recall if it was, as an angel investor, basically. And he had made something like 950 times his money. And so that was a big part of the deck. I invested early in Pinterest. I'm so smart. So I asked him, what's your average check size? And what has been your average check size? And he said, about 100K. I said, how much did you put into Pinterest? He said, 25K. Like, okay, so you didn't even have high conviction on that. So that to me is the perfect example. And this guy's going to go out, or I don't know what happened to him, but I'm sure he went out and raised a bunch of money because he invested early in Pinterest. But if you actually like asked one question like I did, you'd realize that he had low conviction on that investment and it was total luck, right? And that's, to me, that summarizes VC equity investing. It really does.
Unfortunately, you're right, Zach. It does. I think, speaking of Pinterest, though, I do want to bring it back to something else we were saying, that Fred Wilson at Union Square Ventures, absolute beast, right? And I started reading him in like early 20 teens, and like that shapes a lot of how I think about venture. And although he's a coastal investor, they've done things very differently from a lot of their counterparts, right? On keeping fund sizes small, really investing based off of a theme that the entire partnership gets around and has super high conviction around. So they've done some really, really interesting stuff at Union Square Ventures. But one of the things that I think really does differentiate, they have plenty of outliers that have driven consistent returns year over year over year over year. And then they have some that they just find places for. And he goes against the common thinking in VC that you just piece out on the companies that aren't working well, right? So they're not working well, never mind. I'm going to stop showing up to board meetings because I need to put my time somewhere else. That's just chasing deals, right? That's it. But real company building, and he has said this and shows it with data on some of the different portfolio companies, when they're in the trough, for example, that's when you really dig in. The death spiral, I think, as you're writing about, right?
Mm-hmm.
But that's when you really dig in as a VC or as a board member, as a partner to these CEOs, and you figure out how we unlock. And if you can still figure out how to unlock, those are some of the best performing companies. And you get to buy up in the time that they're in the death spiral. So, okay, we made some mistakes. We got here. Let's maybe give you a bridge note or whatever it might be, get you a little bit more capital, buy up some ownership for USV. And then as soon as it unlocks, it can take off. And it doesn't work for everything, because sometimes they're in the trough and they should probably just fail, because some companies do need to fail. Like if you're not finding product market fit, for example. But I think I really appreciate that he writes about that. He wrote about that a few years ago. And I really appreciated it because it almost validated the way that we think about things here as well. It's like, you don't just stop showing up to board meetings because the company made a few bad decisions. Like if you still believe in the market and you still believe in the product, then find a way to try to make it work. And then, but also like be self-aware and look at yourself and say, okay, like, can we make this work? And if you can't, it's okay. Like sometimes you do have to walk away. But I wish more investors thought about it like Fred described in his blog, because I think it would allow a lot more companies with value to find success and not necessarily fail just because they made a few bad decisions in the early days. Who doesn't make bad decisions in the early days? And then sometimes luck like gets them out of it, right? But it's hard to make perfect decisions every day. Yeah, you said this in one of your other podcasts. Like, I think people are an aggregate of every little decision they make during the day, right? And like, sometimes if you recognize a bad decision early enough, then you can change courses. If you don't, probably not, right? But like recognize it, pivot and move. And if you can, then it's worth potentially trying to back those entrepreneurs. And I think that gets overlooked a lot.
So I did want to talk about in the current funding market, we've got a lot of good companies, to your point, that are going to be abandoned by VCs. they're just going to be ghosted essentially, never to get any capital ever again from some of these VCs. But some of them are good companies, and so what I'm seeing, and you're seeing this as well, there's a lot of startups looking for alternative forms of capital to grow the business, bridge them to a slightly better equity market for fundraising. And a lot of them are looking at what's called venture debt, which is what my firm specializes in. So I wanted to talk a little bit about it because I think a lot of folks don't really know that it's a very powerful tool for them. A lot of founders don't realize what a great option this is. So I guess I should talk for a minute just what venture debt is, because a lot of people don't know. It's basically growth capital for companies, startups that are generating revenue, and they're looking for some capital to grow their business, bridge them to the next equity raise, bridge them to an exit, maybe just get them to steady state profitability. Right, so they're just looking for some money, and historically the only way to raise that money was through the equity market. But what a lot of founders are realizing now is that once they've become relatively successful and have traction in terms of revenue that's somewhere typically north of like 10 million, they have other options outside of equity funding. And so a lot of founders have decided, hey, I don't really want to sell my equity ownership. Like, I went through hell to get here over 5, 10, 15 years. And now I can see the light at the end of the tunnel. And I want to keep everything that I've built, right? And so I still need some money, to get over the hump, or to get to a higher peak on the mountain, right? But I don't want to sell equity, or I want to sell as little as possible. And that's where debt is a very powerful tool for these founders, because they can borrow money, and the total cost of capital winds up being significantly less than equity would cost them if they were to be successful, right? And it's also typically much faster to obtain, and it's very efficient in the sense that there's tax breaks too, right? Paying interest, right? So it's a lower cost of capital, faster to obtain, much less dilutive, and so founders starting to like it. But I wanted to get your thoughts as a VC who really focuses on late seed A, mature A, and B rounds. Where do you think venture debt fits in from a founder's perspective? Like, how can it help them? Like, why should they look at it as an option?
We think venture debt's an incredibly powerful tool, which is why I'm here, Zach, why we're friends. But we think it's an incredibly powerful tool, and we've utilized it quite a lot at Fund 4 for Mercury and Fund 5. And so the thing that I think we always talk to our founders about is there is a balance, and I'm actually interested to get your take on this, but there's a point where the scales tip to where it is less expensive for you to take venture debt than it is future equity financing. And at that point, then you take a really hard look, you see where the market is, and you see if it makes a lot of sense to bring that debt on. There are some additional risks of bringing debt on, right? Senior secured loans are very different from someone just owning equity in your company. And so there's some different risks that we always take a look at. But in a lot of ways, venture debt kind of cuts through the bullshit that you have to deal with when you're dealing with VCs. Right. And like I say this, obviously, after I just walked through all the qualitative things we need to care about. But that's because we're earlier stage. And so, for example, where you come in, Zach, is at a point to where typically that happens after we invest. So we have already invested before it's a great fit for venture debt. Sometimes it is, especially this mature A strategy. We're pairing that up with a lot of venture debt, which we'll talk about soon, Zach. But we have a lot of our mature A companies that are a fit are ready to take on some debt capital. Some of the earlier companies, though, it's tougher, right? Because you still are figuring things out. It's not as certain. You still don't necessarily have some of the predictability in the model that we all, including the debt providers, are comfortable with then putting debt on top of the business. So we like to bring debt in once there is some predictability in the model. And at that point, then it makes a lot of sense, and we love doing it, and we love venture debt as a tool for our founders. And it also helps us keep some of our ownership, right? So once our companies get to that point, we would love for it to be less dilutive capital. And so once we're at that, once the companies kind of reach that point, then we're all for it. And we really think it's a powerful tool for entrepreneurs to use. and for VCs to partner up with providers like A.R.I.
Well, you hit on something that a lot of people have misconceptions about. I get a very common question, which is how do you compete with VCs? And my response is we don't compete with them at all. We collaborate with them. And in fact, without VCs funding good companies, there are no venture loans to make, right? You're the top of the funnel. Like, it has to go through you before it gets to me, by definition, right? And so it would be helpful for you to talk a little bit about that relationship that VCs in general have with debt providers, and also what makes some relationships better than others. Like, what can venture debt providers do that will make them more helpful for the VCs and also the founders?
I think it goes down. There's a lot of things, but the one I'll talk about today, I think it goes down to what you and I have already covered on this podcast, that a lot of debt providers think about the financial markets and think about macro and think about fundamentals of finance in a very different way than VCs do. Some good, some bad, but having that other voice in the room with you when you're making key decisions about strategic growth and potential liquidity in the future is incredibly valuable, because a bunch of VCs get in the room and we can all very much disagree on very many things, as we do, but we're still VCs. So we're still thinking about the world through the same lens. And so when you bring in someone who is a different type of capital provider, it actually helps round out how we're thinking about strategic decisions, which then makes the company more attractive as a company grows, and especially as a company starts thinking about either whether it's M&A transacting, but especially when it's going public, IPO markets and some of the more public facing market stuff. So that's where I've seen significant amount of value by working with other types of capital providers with our companies. Another one is sometimes equity is just too expensive. So especially when we're doing roll-up strategies. And so we've done a few roll-up strategies at Mercury, and every time debt has been a super powerful tool for us to use there instead of just equity capital, because at some point equity capital is way too expensive for how much you need to really execute on a good roll-up strategy.
Those are great points. And you hit on something that I talked about with Dan Espinal, who you've referenced a couple of times. And for those that don't know, Dan was on episode 8 of season 2 of the 7-7 show. Great operator, like tremendous operator, great guy, super high integrity, great leader. And we were talking about venture debt. And for him, he said what it really brings to these portfolio companies is accountability. That was the word he used. And I thought he really nailed it with that, because it's very different to raise a round of debt than it is equity. Like we talked about before, you can raise equity with a pitch deck, blow all the money on whatever you want, and nobody's really going to hold you accountable, right? There's nothing they can do to hold you accountable. With debt, it's a different story. You have to have demonstrated success and real money to pay the loan, right? To pay the interest and to pay it down over time. And if you don't have that, it basically signals that your house is not in order. And so I actually think, and we'll put me on the record for this now, we will see over the next 5 to 10 years that venture debt becomes almost like a must-have to validate that companies are real and they're going to be accountable for what they say they're doing. It's basically like a stamp of approval, because you can bullshit some equity VCs, you can't bullshit me. Like, I am going to find out exactly how much money you have and how your business is run and every single weakness. And if you can get through that, it signals to the market that you're the real deal. And what that means is, just by a good venture lender investing or making that loan, your equity valuation should go up just from that signal. Like, you should go from you're worth X today. You pass through this rigorous due diligence process with a very respected venture debt provider. Now you're worth 1.2x right off the bat. And I think venture lenders that are smart will start to realize that and say, hey, if we can help you as a portfolio company build value just by being partnered with you, well, you can share some of that with us too. And I think it's going to start to change the dynamic where smart portfolio companies and their VCs are not just going to look for the lowest form of, or the cheapest form of debt capital. Like they're not going to just go out to some generic commercial bank and say, hey, give me a loan at prime plus 50 basis points. Because in the grand scheme of things, that's small money. Like
Right.
you're trying to become a unicorn and you're telling me you give a shit about like a couple hundred basis points of interest on an enterprise that's worth, you know, 15 to 20 times the loan amount? Ridiculous, right?
Yeah.
And so that's what I think is going to happen. So mark my words, best startups going forward are going to start to partner with the best lenders. That stamp of approval is going to actually catalyze their next equity raise or their exit and increase their valuation almost immediately. That's
I I love it. I love it. I actually think there's another piece of it, which I'm sure you're getting to, but I think you've talked about some of the external validation pieces and the accountability, but it's not just the accountability, right? It's also the CEOs. I mean, the accountability is a huge piece of that. So maybe a sub piece of it is actually that now the CEOs and management teams of these tech startups actually understand and build a new muscle that they have from a reporting requirement or that they have from whatever it might be, that is just a bit of a higher bar or a different bar, right, than some VCs have. And so by building that muscle, it makes them much more versatile as a management team. That is just going to make them better as they continue to scale and think strategically. So I think overall, it's a great, great, great addition to startup ecosystem.
I'll give you a real world example that's tangible.
Yeah.
To get through a debt raise with a reputable debt provider, you're going to need to have a solid data room. You're going to need to have a lot in that data room, and it's going to need to be well organized. You're going to need to have all your ducks in a row, right? Now think about what that means for your next equity raise. Now, when you go to raise equity, you're already exceeding that bar. You're sailing over it as if it was nothing because you're like, I already raised debt capital. That's 10 times harder than raising equity capital, right? And so this is what I think a lot of people don't understand. Going through this debt raise, it's kind of painful. Going through diligence is painful. I mean, it's painful for me in the sense that building my company, when LPs want to invest in my fund, I have a 100-page DDQ built
Oh,
to ILPA standards, right? That's just the starting point. I've got
right.
over like 200 documents in our data room, and it's on point because that's what I need to do to attract institutional capital because that's the bar that they're looking at, right?
Yeah.
And it's very different, of course, in the startup space. The bar is much lower for many valid reasons too, right? Because there's not as much data, not as much track record. I get it, right? But that said, if you're a startup and you want to stand out, and all your peers have like a sloppy pitch deck and a sloppy Google Drive, right? And you're coming with a full-blown institutional quality data room, who do you think people are going to invest in? You or your sloppy peers? I mean, it's a rhetorical question. It's obvious, right? It's like 100% of the time, or 99% of the time, let's say, they're going to go with those that have everything buttoned up. So
Yes, because then that really does, like, just going back to data rooms, even in the early stage where we are, right? Like having your ducks in a row in a point where it's not sloppy makes us think that that's how you're running your business.
exactly.
So if it's sloppy, it's like, that's probably how their Dropbox looks. That's how their customer onboarding process looks. That's how their product specs look, right? So it kind of goes across the spectrum on the stages because it's like, you don't need an institutional quality data room when you're a seed stage company because you just don't have that much information, right? But as you grow, you're working towards that. And I think working towards that is always a good goalpost to go towards for sure.
And perception is reality in the early stage investing world. It is, right? I mean, perception is what people invest on. They're not investing on track record or hard data because it's not there for the most part. So how do you create the perception? It's all about signaling. I mean, it's the same reason we go to good schools. It's not like I learned more at University of Chicago than I would have learned out of a textbook. Like, but it signals to people, oh, Zach must be smart. Like he went to the best business school in the world, right? Yeah, but they wouldn't know that if I could be even smarter. There's many people smarter than me that didn't go there, and nobody is giving
Yeah.
them that respect because they're not signaling it, right? And
Yes.
it's also part of the reason why I think a lot of folks say education is going to go away, or higher education is not going to be necessary anymore. You're not going to need to go to Harvard or Booth or Stanford because you can learn it all online. I'm like, that's not why people went there to begin with. Like,
and that might change a little. And I think the only thing that will change it though is that massively successful people over and over and over again over like decades, if they have different backgrounds, then people start to realize, okay, it's not such a strong signal. I think it's always going to be a signal. I think people are just going to recognize, I think people already are, that there are other signals you can look for, right? Besides a Harvard HBS or whatever it might be. So
no, 100%. Well, so I know we're just about out of time, so I wanted to just give you the opportunity to leave us with some parting thoughts. And maybe it's where we go from here. Oh, actually, before you do, we have to talk about AI for at least 1 minute, because I got to keep the record going of talking about AI in every podcast. So quick thoughts on AI. Do you guys do anything in AI?
Yeah, we do. We've actually been doing some AI things for quite some time. And so AI, the way that we're looking at AI is that it's a very efficient technology that you can apply to certain business models, right? And you can apply it to certain businesses. Some make more sense now, some will make more sense in 10 years from now. And it's really identifying, I think, as our firm. I wish the whole industry was doing this, but we are an industry that chases outliers. So unfortunately, we're in an AI bubble, most likely. But the way that we're thinking about it is, does this make sense for the actual business that you're trying to build? And does it make sense for the customer journey? So we think about the customer journey all the time. And if the customer doesn't care that this is AI enabled, then you have to have a real reason why you're adding that into your product suite. And that helps us cut through a lot of the hype-driven companies out there right now, because when you're in hype cycles, people make a lot of money in hype cycles, right? People do. But again, that's not our model. And so we have to think about what is real here? How does that apply to real businesses? How does that apply to real customer retention or customer adoption? And then that makes a lot of sense. And so that's how we're thinking about it here. We've done quite a few investments in it over the years. We actually have also spun out one of the co-founders of Mercury. His name is Dan Watkins, spun out, oh my gosh, it was probably like 6 or 7 years ago, something like that, Mercury Data Science. And so Mercury Data Science was building a lot of different AI tools or AI enabled products for our portfolio companies. And so we've been pretty deep in it for a while. Mercury Data Science has now been rebranded to OmniScience, which is super, super interesting, but I'll let everyone go check that out if they're interested. So they've rebranded. And one of the things that they're chasing is all of the knowledge that they built up over time over AI, and then how we productize that and then turn that into these consulting contracts that they had, turn that into product type revenue. And they've been able to do it really well. So that's really interesting to us. We have that kind of knowledge bank as part of our Mercury core portfolio. And so we're really lucky there. I would advise people who are out there either looking at AI deals or LPs looking at AI type of funds to make sure that it goes back to your story, Zach, on the Pinterest story. Like, one AI deal or 2 AI deals isn't going to mean you're a good AI investor. So think about, where is the puck going? Why does AI fit into that? And then have high conviction on that and invest around it. So that's how we think about it.
That's great. Yeah, I appreciate that. You nailed it with do customers want it, right? Because just AI doesn't mean it's better. When I call up a company, customer service line, for instance, the last thing I want is something AI generated. I don't want to talk to a chatbot. I want to talk to a human who can solve my problems. People who are applying real intelligence. AI.
Yes.
Like that's the whole point, right? We knew this was coming. We knew it was going to be, AI dominated in 10 years. This is 5 years ago, right? And so the thought was, well, what's going to be the opposite of AI? The opposite of AI is applied real intelligence, human intelligence, in other words, right? And there's a use case for both, but we've got tens of thousands of years of use case for human intelligence working quite well. We don't have much evidence that AI is going to do everything that we hope it will do, right?
Right. And it's also fairly the innovation curve is very steep, and we need to keep a finger on the pulse a lot for what type of data our language models are ingesting and how that actually applies to how people are making decisions. That's another conversation for another
Yeah.
time.
We'll have to get you on again. I know you got to go, and really appreciate you coming on. And thanks everybody for listening to this episode of the 7 and 7 Show with Zack Ellison, featuring Samantha Lewis, a partner from Mercury Fund.